In the process of becoming successful investors, novices inevitably make mistakes. So in this short video, I want to point out 3 of the most common ones which are well worth avoiding. So what are they? First of all, failing to have a strategy. Connected to the second one, which is buying single stocks. In other words, applying a kind of dartboard approach to investing. And thirdly, buying high and selling low. We all think we are going to do the opposite, buy low and sell high, but in fact, all too often, meaning to or not, we do the polar opposite. So let's take a look at those one in turn. First of all, failing to have a strategy. And these are just summary points, cover them in more detail in future presentations. So, no strategy, the challenge. You need to know why you're investing and over what time horizon. You need to understand your personal tolerance for risk so that you're not going to panic sell the moment things go wrong if you invest in the wrong type of security or the wrong type of stock. And you need to understand that asset allocation isn't optional. What I mean by that is people don't realise that your money's got to be somewhere. And even if they're thinking, no, it hasn't, it can just be in cash. Well, even cash has its risks, called inflation and the fact that the real value or spending power is destroyed over time. So asset allocation decisions are not something grand that only fund managers do. It's something we all do, even if we don't realise it. What can go wrong? So the lack of a proper investment strategy. In other words, where you determine how much of your money is going to be in rainy day funds, how much you need for short-term purposes, how much for medium-term objectives, how much for long-term. That's what I mean by a strategy, and then allocate accordingly. What can go wrong? Well, you can get pulled around by noise. You respond to the latest news articles, brokers' reports, you buy, sell, you churn your portfolio far too often. It's easily done because there are plenty of people out there trying to get you to do it. You become obsessed with short-term performance. You lose sight of why you're investing and what your investment goals originally are. And your investment horizon starts to pull in. And worst of all, if the market takes a dip and volatility is much more common than people think it is, we may have just had a period of low volatility, but nonetheless, ups and downs are a part of investing. And if you're not careful, you can become obsessed with those, trying to time the market and avoid them and getting into a mess in the process. You buy assets that simply don't suit your risk tolerance. You need to be honest about how much risk you can actually stomach and what might happen en route to achieving your long-term goals in the meantime. And or you stay in cash far too long. People sometimes get burnt once when they go into stocks on a short-term dip. They pull out, sit on the sidelines, and whilst they're on the sidelines, they're losing out on the best days from an investing perspective. Now, just an illustration of how sitting on the sidelines could destroy your wealth. People often don't see this. It's a kind of hidden risk of cash, if you like. Just a quick comparison on a RPI adjusted, so real basis, between a FTSE all-share investment starting in the sort of worst bear market we've pretty much seen, the early 70s, finishing just a short while ago. Comparison of £25,000 in the FTSE all-share versus £25,000 in cash. Quite a lot of money back then, but the point is, how would those two look side by side, rolling forward? All right, so here it goes. There's the share line. Now you can see the volatility I talked about there. There are lots of bumps along the way. There's one, there's a big one, there's another one. So it's not an easy ride. Yeah, it's a ride that basically did have some quite sharp bumps and dips along the way. And here, that was awful. Anyone who went in here would be thinking, crikey, I made a terrible mistake. But let's look at the person who didn't go in the first place, just sat in cash and thought, well, I'm safe. I don't have to worry about that volatility. Watch where the cash line goes. This is the real purchasing power value. There it goes down to, now remember we start with £25,000 down to more like 2 in real terms compared to 38 from shares, the FTSE all share. So in other words, your purchasing power from cash has been sort of destroyed pretty much, whereas it's not only been maintained, but it's been enhanced in shares, and the gap between those two numbers is quite significant. All right, so there you go, the danger of cash. And people think, well, I'm in cash, I'm safe. Well, if part of your strategy is to hold some cash and you've got a reason for doing so, fine. But it shouldn't just be a no risk, low risk default position, as some people see it. Okay, number 2, buying single stocks. Now, it's tempting. All right, single stock investing is attractive because it's fairly simple. You get a tip, buy the stock. it's relatively cheap because you're not running a portfolio. Okay, single stocks attract a lot of commentaries. There's always someone out there talking about the latest hot tip and trying to persuade you into a particular stock or position. But without proper diversification, you are effectively gambling. And that's true whether you buy big stocks, medium-sized, or small ones. There's a kind of fallacy that if I buy the biggest stocks in the market, I'm always safe. Not true, as I'll demonstrate in a moment. Even the biggest companies can fail and falter. Single stock volatility can be huge, even when you're buying some of the biggest stocks in the market. And dividends can be cut or eliminated altogether by almost any firm if and when it hits cash flow trouble. Dividends are not guaranteed. The directors decide how much they're going to pay and how often. And complacency among shareholders can lead to trouble when companies need to rein in, pull back and make changes. Now, to illustrate that point, no better example than BP. There are plenty of others I could point to. If you remember the Deepwater disaster, that had a catastrophic effect, the big oil spill, on BP's share price. There it is, basically halved it, dividend was slashed, okay, and investors got a nasty shock, and that was the biggest company in the market at the time, a position it held for some time, still a pretty big stock now. So it just goes to show that even the mighty can fall. Don't put all your eggs in one basket. Don't be lulled into the sort of single stock approach. As to how many stocks you need for a diversified portfolio, it's not actually as many as some people think. Quite a few studies have shown that you can reduce single stock risk quite substantially. There goes the line. Down from sort of 100%, if you like, where you've only got one stock, you can reduce it quite substantially to really a fraction of that once you get up to around 15 to 20 stocks, a message I reinforce in other videos. So, diversifying is the way forward. Of course, a diversified portfolio won't be protected if the entire market takes a crash, but it will protect you against that quite potentially catastrophic single stock risk I mentioned. Number 3, buying high, selling low. The exact opposite of what we want to be doing, but so easy to do. So investors should be, Warren Buffett said, greedy when others are fearful, buying when others are selling, and doing the opposite. But in practice, it's not that easy to do. You have to really be quite strong-willed to go against the crowd, have the courage of your convictions. Most people actually don't. They kind of panic with the rest of the market, and they only get back in when everyone else seems to be buying and getting some confidence back. So we end up buying the biggest, most successful stocks in the market. And this is one of the problems, by the way, with simply tracking a big index like the FTSE 100. It is a market capitalization weighted index. So the biggest stocks rise to the top of that index to take the top positions. If you track that index, you are automatically buying into stocks that are already big and already expensive. And that's not ideal. Just a word there. Panic sellers will then often leave the market. It's kind of a double whammy. They try and get out when everyone else is selling, so prices are poor, liquidity is down, so that hammers them even more on price when they try to get out. Then they sit on the sidelines and miss some of the best investing days in the market. So, going quite quickly here, but in summary, don't waste a lot of time and energy on trying to time the market. As a long-term investor, it makes much more sense to spend time in the market. And investment horizons for even someone my age, in their 40s, should be at least another 30 to 40 years based on projections of longevity these days. Don't fully invest when prices are high. Don't rush into the latest stock that's hot, as it were, and make sure you're not just focusing on capital gains, you're keeping your eye on income. Because after all, it's income that we need to spend, to live on and so on. Capital is something that we look to accumulate over time, because we never know, frankly, when we're going to be able to cash in our capital, if at all. Now, just to illustrate the importance, if you like, of hanging on in there, not panicking, let's look at that big bear market again, 1971 to 1974. Somebody who invested in stocks and shares, £25,000, would have been pretty depressed just 3 years later, having had it reduced to just £8,600. Someone who sat smugly in cash would still have, in nominal terms, that's uninflation adjusted, £25,000. But here's my point, widen out the picture, just a quick reminder, and this is in nominal terms this time rather than inflation adjusted. On the last slide I did along these lines, your FTSE all-share investment looks considerably better than your cash investment over a much longer investment period, albeit there's that volatility again getting in the way in the meantime. And finally, just to make the point about dividends, so really the importance of dividends, if you look on a total return basis at a similar picture from the early 1970s right the way through to much more recently, comparing UK equities, a basket of them, as Barclays did there, to a building society deposit, you get, again, a similar sort of picture. Yes, there were some periods of reasonable interest rates there, so the deposit has climbed up to £396,000. That's rolling up interest as well as capital. But your UK equity total return, not inflation adjusted admittedly, up to 2.2 million around the point that graph was cut off. So my point there is that dividends matter, staying in the market matters, not panicking when you get these periods of volatility, and making sure that you're committed to an investment strategy that works for you. So there it is, 3 common investing mistakes in summary. First of all, make sure to avoid them. You've got an investment strategy. Don't do too much single stock investing, if any, and make sure you are genuinely buying low and selling high.